The Liberation Day announcement from US President Donald Trump could be the biggest game changer for global trade, economic, and financial arrangements in almost a century. With a blanket 10% base levy combined with a hefty reciprocal tariffs for its largest trading partners, the US effective tariff rate could shoot above 20%, a level unseen since the Smoot-Hawley Act in the early 1930s, right before the Great Depression. So how do we interpret the event and what are we watching from here? In the near term, all eyes are on the implementation of tariffs and other countries' reaction. Some countries, such as Vietnam, have already expressed interest to negotiate, while others, such as China, have fought back tit for tat. The majority of countries are in between, holding their cards close to their chest. How these countries react to the U.S. moves will determine the scale and direction of the trade war and its ultimate damage on the global economy and financial markets. Beyond that, we'll need to focus on the impacts of tariffs. Trump's base levy is universal, meaning that everyone will take a hit. But the differential reciprocal tariffs will create relative winners and losers. Mexico, Canada, and LATAM seems to got off lightly so far, while Asia has been hit the hardest. If this pattern stays, it could have profound implications on how supply chains may be reconfigured in the future years. As for the US, tariffs are stagflationary. They raise inflation while weigh on economic growth. This is already reflected in the recent soft data, and our fear is that with the tariff scare turning into reality, the weakness in the soft data could start to morph into hard data. The good news is that the balance sheets of US consumers and businesses are still healthy, which should help to cushion the economic downturn, all else being equal. However, given the scale of the shocks, still elevated policy uncertainties and bleak market reactions, which could tighten financial conditions, the odds of a recession are clearly on the rise. A slowing US economy will in turn deal a second-round shock to the rest of the world, exacerbating the direct impact from tariffs. Stagflation will put the Fed in a tricky spot. Our view is that after the dust settles, tariffs are a bigger medium-term shock to growth than inflation, and therefore won't derail the easing path for the Fed. We still look for 3 interest rate cuts for this year. Overall, the economic and policy uncertainties are at record levels, and our views will need to be adjusted as the environment changes. Given the current macro trajectory, we see the balance of risk to the global economy skew strongly to the downside.
So what happened on the markets? We see commonalities with the risk-off playbook, with some particularities on US assets. Correlation among assets increased quite drastically last week, but core duration, Japanese yen, and gold returned positive performances. Equity were under pressure. They are still. Initially, stocks sensitive to trades were under pressure, and eventually it moved to all stocks, especially cyclicals like financial and discretionary. High yield saw an acceleration of spread widening from relatively tight levels. So what is the main particularity this time? It's on US assets. US equities suffered more within the global equity sphere compared to their beta. US dollar was not a safe haven and depreciated in trade-weighted terms. So how to react now? We should resist the pressure to over-reduce risk in this highly volatile environment. You should avoid very large allocation bet at this stage. We should not try to time the markets, very complex, but focus on long-term goals. Take opportunities at the company level. Markets overreacted in some industries, as we saw a macro-driven drawdown more than a micro one. True, risky asset can suffer more if a full-fledged recession is confirmed, but it's not the base case yet. History shows that risk is more symmetrical, with potential for tactical squeeze in equity after such a sell-off, despite the fact that we will have negative revision to earnings. So what to do in portfolio from here? Our conviction is that we should reduce high yield. Risk-reward is not very favorable because spreads today are still not pricing the current probability of recession. What to do on equity? We believe we should remain invested but maintain protection and keep diversification. Use stock picking to shield yourself from high cyclical and exporters from now. Prefer domestic defensive play, typically in China A shares or India, that could offer some protection. Use duration. Further monetary easing will be priced in over the next 18 months. Prefer the short end of the curve because whether we have a recession or a stagflation, it means curve steepening. Call rates like Euro curve or Asia rates in local currency hedged are our best pick. Overweight developed low yielders versus dollar, especially the yen or the euro. The recent trend might be extended further, but maintain a general underweight in Asia FX because the magnitude of the tariff will be incorporated into the growth outlook and it may open the door to cuts from Asia's central banks. Lately, for commodity, overweight gold and silver and underweight oil because baseline growth will go down further from here.